If you're a business owner, you absolutely dread bad debts. It feels like a punch to the gut every single time. But what if you could turn that painful reality into just another manageable, predictable part of doing business? Today, we're going to talk about how to turn those frustrating losses into some really valuable lessons. So let's kick things off with a big question, one that gets right to the heart of this. When you make a sale, you book it as income, right? But what happens if that customer just never pays? Well, the government might still see that as profit. Think about that. You could be paying taxes on money that will never, ever hit your bank account. That's a serious drain on your profits, and it's exactly what we're here to fix. So here's what we're going to cover. First, we'll get a handle on the problem itself, the profit drain. Then we'll look at the anatomy of a write-off, how to react. After that, we're going to get proactive. We'll talk about planning for future losses and how to estimate them. And finally, we'll get to the good part, the payoff, and what this means for your real profit. All right, let's dive right in. The first thing we need to do is frame this correctly. A bad debt isn't just some counting headache. Nope, it's a direct attack on your business's hard-earned cash. And to really get why, we need to be clear on one key concept. And that concept is your accounts receivable. Basically, this is a pile of IOUs from your customers. The moment you make a sale on credit, you record it as income, so on paper, your business looks fantastic. But the key thing to remember is you haven't actually seen a dime of that cash yet. And this is where things get tricky. When that IOU goes unpaid, your accounts receivable sours and turns into a bad debt. I love this analogy. Think of it like a silent partner you never asked for, one who just shows up, takes a slice of your profits, and then vanishes. You've already done the work, you've paid for the materials, but poof, the revenue is gone. Okay, so it happened. A debt has officially gone bad. What do you do now? Well, the first step is reactive. It's about how you officially handle that loss in your books after the fact. We call this a write-off. Now, hold on. You can't just wake up one day and decide an invoice is a goner. There are specific triggers. The rule of thumb is you should only write off a debt after you've tried everything, all reasonable efforts to collect it. So what does that actually look like in the real world? And this is the really important part, right? The criteria are pretty specific, especially for tax purposes. For example, if you get a bankruptcy notice in the mail, that's a clear signal. You have to stop all collection efforts immediately. For the others, you gotta have proof. If they've disappeared, you need to show you tried to find them. The bottom line is, the chance of collecting that money has to be truly, verifiably zero. Okay, so reacting is one thing, but just playing defense? That's not gonna cut it. The smartest businesses get out in front of the problem. And that brings us to the proactive approach, actually anticipating future bad debts and building a system to handle them before they even happen. And the secret weapon here is something called a reserve for bad debts. This quote says it all. Think of it as a financial shock absorber for your business. It's this little cushion you set aside to cover those bumps in the road, so one big bad debt doesn't completely wreck an otherwise profitable quarter. And you know what? The process itself is surprisingly simple. It's just 2 steps. First, you create the provision. That's where you estimate your likely losses and record that amount as an expense. Then, later on, when a specific debt actually goes bad, you just write it off against that reserve you've already built. Let's see how that looks in the books. So step 1 is all about making that provision. You're basically creating an expense now to plan for a future loss. Why? Because it matches the potential expense with the sale you just made. It gives you a way more honest look at your profitability for that month or that quarter. So what does this look like in your accounting software? It's pretty straightforward. First, you record a bad debt expense. This lowers your profit on paper, which, remember, gives us that more realistic picture. At the exact same time, you credit your reserve for bad debts account. That's our shock absorber. We're essentially moving money from potential profit into our rainy day fund. Now fast forward a few months. That one invoice? It's officially dead in the water. Time for step 2. And the beautiful part of this is you are not taking another hit to your profits. You already accounted for this possibility way back in step 1. The entry itself is super clean. We debit our reserve account, which shrinks our little shock absorber fund, and then we credit accounts receivable for that specific customer. This wipes their unpaid invoice off our books for good. The loss is covered, our books are clean. Everything is perfectly balanced. This all sounds great, I know, but it all hangs on one really critical question. How in the world do you actually estimate how much money to set aside? It can't just be a wild guess. Well, fortunately, there are a couple of common, well-established ways to do it. So, which one's for you? Well, it really depends on what your business looks like. If you only have a few very large clients, you can do a case by case analysis. Your personal knowledge of their financial health, their payment history, that makes for a really educated guess. But if you have hundreds of smaller customers, it's way more practical to use a historical loss ratio. Just look back at your credit sales and bad debts from the last few years and figure out your average loss percentage. Now, here's a really important piece of advice no matter which method you use. You have to be reasonable. Let's say last year you had one massive, totally unusual bad debt because a huge client went bankrupt out of the blue. You should probably exclude that from your calculation. Otherwise, it's going to distort your estimate for a typical year. The goal here is a fair picture of the future, not a skewed one. All right, we've gone through the why and the how. So what's the big payoff? Why go through all this trouble? Because managing your bad debts properly isn't just about clean bookkeeping. It actually leads to smarter, more profitable decisions for your business. I mean, why does this really matter? The payoff is huge. First, your profit and loss statements start to reflect reality. Second, you stop paying taxes on those ghost profits we talked about right at the beginning. Huge. Third, your cash flow forecasts become way more reliable. And finally, when you walk into a bank asking for a loan, you can hand them financial reports that prove you are on top of your game. That builds some serious confidence. Okay, one last really important little detail here. Everything we've been talking about, the reserves, the write-offs, this all applies to businesses using accrual accounting. If you're using cash accounting, things are much simpler. Since you only record income when the cash actually lands in your bank account, a bad debt never even hits your books as income to begin with. So there you have it. You're all set to manage bad debts proactively and turn those painful losses into a predictable part of business. But this leaves us with one final thought. Managing the problem is one thing, but what about stopping it at the source? Is your credit policy, your process for deciding who gets credit, strong enough to prevent these debts from ever happening in the first place? Now that's the next level of financial mastery.